Fast forward 10 years, business is doing good and our bakery is currently worth $1 million. In the first scenario, the all stock scenario, my 20% stake is now worth $200,000 and each of my 8 investors' 10% stake is worth $100,000. Second scenario, all bonds, my 100% stake is now worth $1 million minus the $16,000 I paid to investors, which is $984,000. Third scenario, 50 stocks, 50 bonds, my 33.3% is now worth $330,000. Each of my 4 investors, 16.6% is worth $166,000, while all my bondholders have been paid up. Fast forward 10 years in an alternate universe where the bakery is doing terrible. Although we started with $10,000 10 years ago, we're only worth $16,000 right now. In the first scenario where I raised the $10,000 through all stock, my 20% is currently worth only $3,200, while each of my 8 investors' 10% is worth $1,600. Second scenario where I raised the money through all bonds, my 100% is worth 0. This is because I had to pay $16,000 to my creditors because they are higher priority. So once I pay that off, I'm left with nothing, flat broke. Third scenario where I did a 50-50 between stock and bonds, we pay our creditors first because they're higher priority, so that they get paid $2,000 each. 4 creditors, $8,000. We're left with only $8,000. My 33.3% is only worth $2,600 and each of my 4 investors' 16% is worth $1,300. In this situation, we can see a 50-50 between stocks and bonds is always better if there's a chance the company might go out of business or might perform terribly. But if it's 100% certainty, which is never possible, that the company will be successful, 100% bond is better to raise capital.